Imagine a world where you no longer work for money, but instead, your money works for you. Monday through Friday, 9 to 5, mandatory overtime. Could this even be possible? Could a world like this exist? It does. Want to know where? Came to the right place. Welcome to the vault. What's going on, YouTube family? It's your favorite headless YouTuber back at it again with a brand new video. And before we get into it, here's our Monday motivational quote. People who are crazy enough to think that they can change the world are the ones who do. Now, as you probably guessed from reading the title of this video will talk about what exactly stocks and stock options are. We will break them down to the most minute, molecular level possible, exploring everything you could ever know about them from the very beginning of their conception. Doesn't it sound exciting?
Nope.
Of course not. One thing you should know about us, we like to keep it simple, especially when it comes to the stock market. Now, it's nice to know these fun facts here and there, but they are not crucial to your understanding of the market. If it doesn't help make more money more consistently, and it's just that simple. Before we get into today's video, I want to congratulate everyone that was able to play any of last week's trades. We were 3 for 3, 100%. Doesn't get any better than that. It always feels good when we can provide educational value and cash money dollar value through our channel. Don't worry, if you missed last week's plays, we have a brand new list of money makers for you this week. So be sure to stick around to the end. If you want us to make more videos more often, please be sure to subscribe to the channel below, turn on the notification bell so you don't miss any new content. Without further ado, let's get to it. So, what exactly is the stock market? The stock market is a public entity where individuals and institutions buy and sell shares of publicly traded companies. The important thing to always keep in mind when trading or investing in the stock market is that every transaction is an exchange with someone else. So anytime you buy shares, there has to be someone on the other end to sell them to you. And vice versa, when you sell your shares, someone has to buy them from you. Stocks are listed and traded on stock exchanges, the largest being the New York Stock Exchange, or NYSE. U.S. exchanges are open Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Standard Time, excluding bank holidays. The stock market is by far the best wealth building vehicle that anyone can take advantage of with the right knowledge and understanding. One reason being return on investment. Historically, the return on investment from the stock market has far outperformed most other investments in the long run. Second reason being that cash is currency, meaning that cash has to be moving constantly or it dries up. Today, your money is no longer safe in traditional savings accounts. The national average interest rate for a traditional savings account is 0.04% annually. That is 40 cents a year for every $1,000 in your savings account. And when you add the fact that the annual inflation rate is currently 5.37%, you realize that you're actually losing money every year for holding in your savings account. For those of us that may not completely understand what inflation is, simply put, it's the percentage amount our dollars lose in value yearly due to the increase in goods and services like groceries and gas. For example, when I was growing up, we could go to the store with $5 and come back with 2 drinks, 4 bags of chips, a couple honey buns, and still get the milk we were actually sent to the store for. That same $5 today wouldn't buy me nearly as much. Maybe a bag of chips and a Sprite, but mine definitely would not be getting that milk. This is just a small example for why investing in the stock market is so important. Let's talk about the different types of stock market investments that you can make. There are several ways to take advantage of investing in the stock market. The two we'll focus on today are stocks and ETFs. Stocks are securities that represent ownership of a fraction of a company. The units of a stock are called shares. Companies issue shares in order to raise funds to operate their business. By being a company shareholder, you gain access to things like voting rights and dividend payments. Now, there are levels to this. Just because you have a few shares of Apple doesn't mean you get to walk into Apple HQ and start making changes and barking orders. I mean, you could, but just know I won't be there to bail you out if you do. Now, ETFs or exchange traded funds. ETFs are similar to stocks in that shares of them can be bought and sold on the exchanges. However, ETFs differ in that they offer exposure into a wide range of stocks by grouping them into one basket under a unique ticker. Think of it like buying a variety pack of chips. Instead of having to choose one flavor, you can buy 5 flavors at once. ETFs are typically a safer bet because even if 1 or 2 of the stocks within the ETF perform poorly, you can still benefit from the majority of the variety pack performing well. Now, before we continue, if you're enjoying this video and want us to make more videos more often, be sure to hit that like button below and subscribe to the channel. Also, comment below your thoughts and questions and let us know what you want to see covered in future videos. Now that we have a better understanding of stocks and the market itself, let's talk about my favorite way to take advantage of stock market investing: options. As I'm sure you can agree, there's nothing better in life than having options. And if you ask me, the same applies to the stock market. Options, or option contracts, are agreements between 2 parties to buy or sell some underlying stock at a predetermined price by a specific expiration date. The predetermined price is referred to as the strike price. The strike price is basically where you expect the stock's price to reach or surpass by the expiration date. The expiration date is the last date to exercise a contract. After the expiration date, the options contract becomes worthless. The time between now and the expiration date is directly linked to the value of the options contract. More time is more valuable since it gives more time for the stock to move in your favor. Buying an options contract offers the right, not the obligation, to purchase or sell the stock. So you are not forced to exercise a contract if you choose not to. The 2 types of option contracts are call options and put options. Call options are purchased to speculate that a stock will increase in value by the expiration date and give you the right to buy the stock at the strike price. Put options, on the other hand, are purchased to speculate that a stock will decrease in value. Puts give the investor the right to sell the stock at the strike price. For example, XYZ stock is priced at $50. You expect it to rise to $60 by September 17th. If you were to buy an option contract, you could purchase a call option with a $51 strike price and a September 24th expiration date. Now, I know what you're thinking. If you expect it to go up to $60 by September 17th, why would you choose a $51 strike price and a September 24th expiration date? Where'd you get those numbers from? The answer is simple: insurance. When choosing a strike price, we found it to be best practice to pick a strike price closest to the stock's current price. By choosing the $51 strike instead of the $60 strike, you give yourself the extra cushion for your trade. If XYZ never reaches $60, but it still goes up, but only goes up to $53, your contract will still be profitable simply from XYZ moving in the direction that you predicted. I also choose the September 24th expiration date for the same reason. You can never have too much time on your contracts. Adding an extra week gives me some wiggle room to be wrong and not suffer much from it. Another very important thing to note about options is that each option contract represents 100 shares of the stock. So exercising an option contract means that you choose to exercise your right to purchase or sell 100 shares of the stock per contract you own, assuming the stock has reached or surpassed the strike price before expiration. Now, stay with me. Here's an example. XYZ stock is currently priced at $50. You expect it to rise to $60 by September 17th. So you buy a call with a $51 strike price and a September 24th expiration date to give yourself the extra cushion and insurance for your trade. In order to exercise this contract, the stock's price has to reach or surpass the strike price, or in this case, $51 by September 24th. Exercising this contract will mean that when XYZ rises to $51 or above, you have the right to buy 100 shares at $51. So if XYZ rises to $60 just as you predicted, you're able to still buy shares of XYZ for just $51, immediately locking in profits of $9 per share, or $900 since there are 100 shares per contract, and 100 times 9 is 900. You do not have to wait until expiration to exercise. If XYZ shoots up to $70 tomorrow, you can exercise it then, lock in your profits with no problem. Okay, let's do the math. If each option represents 100 shares, and we were to exercise our right to buy XYZ at $51, we'd be buying 100 shares of XYZ at $51. 51 times 100 is $5,100 or $5,100. And that's just for one contract. Now, I know what you're thinking, but oh great headless sensei, I don't have that kind of money to invest in one play. You're telling me there's not a cheaper way to trade options? Man, am I glad you asked, because there is a much better way, preferred by most, including myself. Most people don't exercise option contracts. We trade options, meaning we buy in at a low premium and plan to sell the option contract back into the market to another investor for a profit. The options premium is the price for which the option contracts trade, or basically what you'll pay for the option contract. Premiums are presented as price per share, because an option contract represents 100 shares, a premium listed as $1.25 would really cost you $125. $1.25 times 100 equals 125. And I know math isn't everyone's strong suit, so just remember to move the decimal point 2 places to the right when looking at options premiums to get the price that you'll pay. The key is just to understand what you're looking at and what it's telling you, because most of your brokers are going to do those calculations for you. There are several factors that influence the change in premium. The key is to accurately predict the direction of the stock's price. When a stock's price rises, so do the premiums for the call options for that stock. When a stock's price falls, the put options premiums will increase in value. It's really just that simple. We apply the same rules and strategies we use for entry and exit on our stock positions to our options trading. You know what that sound means. It's time for our 3 stock plays for the week. Full disclosure, we inside the vault trade options and invest in shares. So unless otherwise specified, any trades or stocks we alert on the channel are options plays. We suggest that you take the time to learn what options are and practice trading them before participating in any options trading. If you would like all of our weekly and monthly stock alerts along with full detailed insight behind each alert, click the link below to become a VIP member today. Now, for our 3 stocks to buy this week. The first stock is Ross Stores Incorporated, or ticker symbol ROST. According to our analysis, Ross looks ready for a reversal upward. We will be entering call positions with October 8th expirations or later. Next up is Dick's Sporting Goods, or ticker symbol DKS. After a great week from Dick's, we expect it to start to cool off later this week. We will be entering put positions with October 8th expirations or later. Finally, we have Aspen Technology Incorporated, ticker symbol AZPN. We believe AZPN may be ready for a solid move upward and will be entering call positions with October 8th expirations or later. With all of our trades, we set profit targets rather than price targets. So we'll be looking for a 15% or greater return from each of these trades. Also bear in mind that we follow a set of rules inside the vault when it comes to our trading. One of which being to scale into our plays, so that even if the move doesn't happen immediately, we're able to average into the positions and consistently get great entries on our plays, which is how we were able to be profitable on all of our trade alerts from last week. As always, do your own due diligence with every investment to make sure it fits your criteria. And of course, invest or trade responsibly. All right, that'll do it for today's video. If you want to get the most from this video and any other content we post on the channel, we suggest that you watch the videos multiple times, as many times as you need to fully grasp the information that's presented. The stock market is like a foreign language, and to understand it, you have to put in the time to learn it. Tune in next week as we finish our breakdown of options and give you the $1 million secret to options trading. If you've enjoyed this video and want us to make more videos more often, you know what to do. Be sure to hit that thumbs up button below, subscribe to the channel if you haven't already. Also, comment below your thoughts and questions to let us know how we can continue to improve this channel. This channel and all of this content is made for you. Thank you for watching, and I'll see you in the next one.